If you read, like, the financial press right now, you'd think the American office building is just functionally dead.
Oh, yeah, completely dead.
Right. You see these constant headlines about massive urban vacancies or, institutional investors just handing the keys back to their lenders.
50-story glass tower sitting entirely empty.
Exactly. But then you pull up the local data for one specific city in Idaho, and the numbers tell a completely different story.
A wildly different story, actually.
Yeah. Over the last 12 months, the local market absorbed a staggering 80,000 square feet of office space.
Which is just jaw-dropping when you consider the national doom and gloom narrative right now.
It really is. Today, we're figuring out exactly how a secondary market is completely beating the national real estate crash. So welcome to the deep dive.
Glad to be here for this one.
Today, our scope is laser focused for you on the office market in Coeur d'Alene. That is Coeur d'Alene, Idaho. Specifically for the first quarter of 2026.
Right.
And just for simplicity, for the rest of our analysis, we're going to refer to it exclusively as the CDA market.
Makes sense.
We really want to isolate the variables that make this region behave so, differently from the major metros.
Well, to set the baseline for you, we have to establish the provenance of our information.
Right. Where is this coming from?
We are working from a custom Q1 2026 research brief alongside CoStar Capital Markets data, and this was prepared by ACTIV8 Real Estate. We're specifically analyzing data curated by Eric Peterson, and you can actually reach him directly at 509-903-9077.
Because relying on this localized intelligence is really the only way to cut through the noise of national averages, right?
Exactly. You can't just look at a national chart and understand what's happening on the ground here.
I sort of think about the national real estate landscape like a massive interconnected weather system.
Okay, I like that.
Nationally, you have this brutal climate-like interest rate droughts and remote work winters just freezing up the market.
Yeah, absolute like freeze.
But the CDA market is operating almost like a sealed terrarium. It's generating its own internal climate, completely insulated from the broader storm.
That is a perfect analogy. And before we really dissect the trends, we need to establish the baseline facts for the listener so they know exactly what kind of terrarium we're looking at.
Yeah, let's look at the vitals. So trailing 12-month data, the vacancy rate is sitting at just 4.2%.
Which is actually lower than the market's own 10-year average.
Wait, really?
Yeah. So we aren't just seeing stabilization, we're seeing a historical tightening.
Wow. Okay, so let's clarify the mechanics on that 80,000 square feet of absorption we mentioned at the start.
Sure.
When the data says absorbed, we aren't just talking about gross leasing where businesses just shuffle from one building to another, right?
Right. Oh.
This means net new space was physically taken off the market.
Correct. Net absorption means more square footage became occupied than became vacant.
Okay.
So businesses either moved into the market or existing local businesses expanded their physical footprints.
And at the same time, the money changing hands remains remarkably consistent. Over the trailing 12 months, we saw a steady $11 million transacted.
Yeah, with the total market asset value for office space sitting right at $813 million.
But the metric that really jumped out to me, like the one that defines the economics of this entire terrarium we're talking about, is the yield.
The cap rate.
Yes. The current estimated market cap rate is sitting at 10.5%.
Which is massive.
Right. So we're going to spend a lot of time on what that means for buyers.
Yeah.
But if we synthesize these baseline vital signs for you right now, despite national headwinds, the CDA market is tight, stable, and driven almost entirely by local demand.
Exactly. The data points us to a localized ecosystem that's just operating on its own distinct set of rules.
So what's the first rule?
Well, we can break it down into a few major behavioral trends. And the first one is a real reality check on the whole return to office narrative.
Oh, I noticed this in the brief. There's massive demand, but it's highly concentrated in very specific spaces.
Yeah, small office suites, specifically footprints under 5,000 square feet.
So we're not talking about enterprise-level tech companies taking down whole floors.
Not at all. The occupier profile is entirely different here. The primary drivers are small professional services firms.
Like who?
You're looking at local wealth managers, boutique law practices, specialized accounting firms, regional marketing agencies.
Oh, okay. That makes sense.
For these specific businesses, physical face-to-face interaction is a core component of how they build client trust and just handle daily operations.
So they're back in the office.
Yeah, they've returned to near normal in-office schedules because their business model basically requires it.
I mean, I have to challenge the long-term viability of that, though.
Okay, how so?
Is this just a delayed post-COVID bounce back? Like, are these local firms temporarily reverting to the mean, or is it a structural reality that small professional services in a secondary market simply can't operate effectively fully remote?
That's the big question.
Because if it's just a temporary cultural lag, that demand might eventually soften and mirror the big cities, right?
Well, the data heavily suggests it's a structural moat. Yeah. In a smaller owner user-dominant market like CDA, business relationships are heavily localized.
Right.
You know, you can't build a local wealth management practice purely over video calls when your competitors are meeting clients in a nice physical downtown office.
Yeah, that's a really good point.
It's a stark contrast to large urban markets where massive remote flexibility remains deeply entrenched.
Because the work there is largely asynchronous or nationalized anyway.
Exactly.
So the physical office is actually a competitive advantage for them in this market.
Absolute.
But, that also creates a constraint for you to watch next quarter. If this intense demand for sub 5,000 square foot space holds steady, that 4.2% vacancy rate is going to drop even further.
Right.
At some point, the physical space just runs out, or they're forced to start new construction.
And that leads directly into the second major trend we're tracking, the pricing floor and the cap rate gap.
Let's get into that, because that 10.5% cap rate is wild.
Yeah. So to understand the local valuation, we have to look at the macro cost of capital. Nationally, the shock of rate hikes has finally worn off.
Thank goodness.
Right. Buyers have largely accepted the higher interest rate regime as a permanent baseline, and pricing for commodity office products has hit its floor.
And nationally, that floor is pretty low.
Oh, yeah. Often down 30 to 50% below their 2021 peaks in major metros.
So the bleeding has essentially stopped. But because prices reset lower while rental income generally stayed flat, national cap rates expanded.
Exactly. A lower purchase price for the same income means a higher percentage yield.
Right, the math is straightforward. Nationally, office cap rates are sitting around 9.0%.
Yeah.
But like we mentioned earlier, the CDA market is at an estimated 10.5%.
Yeah.
That's a full 150 basis points higher than the national average. Why is the market demanding such a high yield here?
It comes down to perceived liquidity and institutional mandates.
Okay, unpack that.
Wall Street funds and national investors often mandate a higher yield for secondary or tertiary markets because they view them as less liquid. Ah, right.
If they need to sell an asset quickly, there are fewer buyers in Idaho than in Manhattan, so they'd price that illiquidity into their models, demanding a higher return.
I kind of like to view that 150 basis point gap as a small town tax. Like it's a risk premium outside money imposes.
That's one way to look at it.
But I mean, if you're a private investor listening right now, looking at the actual fundamentals, the 4.2% vacancy and the steady net absorption, you could easily argue it's actually a stability discount.
Oh, absolutely.
You're getting a significantly higher yield on an asset class that is dramatically outperforming the major metropolitan areas in terms of actual physical occupancy.
And that is the critical inefficiency in the market right now. You are being compensated with a higher yield for taking on perceived geographic risk, when the actual operational risk, the risk of your building sitting empty, is empirically far lower in the CDA market than in a primary urban core.
So watch next quarter if out-of-state yield chasers start buying up CDA assets to capture that higher cap rate. Yeah, that capital migration is definitely a watch item. But if that outside capital decides to migrate and buy up CDA assets, they're going to run into a massive brick wall.
Which brings us to our third trend: zero construction and tightening supply.
Right.
Over the last 12 months, year over year and quarter over quarter, the market saw a grand total of 9,000 square feet of office space delivered.
A tiny amount. And looking ahead, there is exactly 0 square feet currently under construction.
Wow, 0.
Yeah.
Let's break down the mechanics of why that is.
Yeah.
Because if vacancy is incredibly low and demand is high, basic economics says a developer should step in and build more supply, right?
Usually, yes.
So why is the pipeline completely dry?
The math simply does not underwrite a new development right now. Construction requires short-term floating rate debt.
Okay.
With current interest rates, the cost to borrow that construction money is astronomical.
Right, of course.
When you combine elevated debt costs with the lingering high costs of raw materials and labor, the final price tag to build a new office building is just massive.
So the developer is basically stuck.
Yeah. To make a profit, the developer would have to charge rental rates that far exceed what the local market can currently bear.
So unless a developer has a tenant willing to sign a pre-lease at astronomical rents, just to justify the shovel hitting the dirt, they just stay on the sidelines. The numbers don't work.
They don't. And this creates a fascinating dynamic for current property owners.
I bet.
If you hold a stabilized asset in the CDA market today, this zero construction environment deeply protects you.
Your building is effectively a fortress.
Exactly. You hold immense pricing power during lease renewals because your tenants have virtually zero new supply to leverage against you.
On the flip side, if you're a growing local business looking to expand your footprint from, say, 3,000 to 6,000 square feet, your options are severely limited.
Very limited.
And the forecast has vacancy remaining incredibly tight, ending 2026 around 4.5%.
Yeah, remaining very healthy.
So if nobody is building, and the buildings that exist are full, who is actually managing to buy and sell in this environment? Let's dig into the transaction data.
Sure. But before we break down the deal profiles, I need to outline a constraint in the data for you.
Okay, what's that?
We are analyzing aggregated trailing 12-month metrics sourced from CoStar and broker reports.
Right.
The data strips out the specific names. So specific buyer names, seller names, and individual property addresses are not specified in the report. We are looking strictly at the behavioral footprint these transactions leave behind.
I mean, I always wish we could name drop the exact players making these moves, but even without the names, the numbers leave a very clear footprint.
They really do.
Like, I noticed a massive discrepancy in the significant deals highlighted in the report.
Oh, the cap rate difference.
Yeah. On one hand, you have a transaction handled by NAI Global and Anywhere for a volume of $4 million, trading at $158 per square foot.
Mm-hmm.
That deal closed at a remarkably low 5.0% cap rate.
Right. And then contrast that with the volume from Kootenai and Hayden. They closed 4 deals totaling $5 million, trading at an average of $68 per square foot and a 6.5% cap rate.
I really have to pause on that 5.0% cap rate on the NAI Global deal because it breaks the logic we just established.
How so?
If the market average cap rate is 10.5%, why would a buyer ever accept a 5.0% yield? I mean, an investor relying purely on cash flow would be bleeding money compared to market norms.
That's true.
Is someone making a massive value-add play where they bought an empty building to fix it up?
Usually no. When you see a cap rate compress that far below the market average in a secondary market, it almost exclusively points to an owner-user dynamic.
So a business buying its own space.
Exactly. A strategic business purchasing its own real estate isn't calculating their return based solely on rental yield.
Right. They're not a traditional landlord.
Right. They are factoring in the long-term operational stability of controlling their own physical location, tax depreciation benefits, and protecting themselves from future rent hikes.
Oh, that makes perfect sense.
They will pay a premium, driving the cap rate down to 5%, because the real estate is an operational necessity, not just an investment vehicle.
Okay, so they're buying the utility of the building, not just the math.
Exactly.
When you blend the user-driven sales with the more traditional investment stock, the average deal profile sits around $2 million. The average price per square foot is $113.
Yep.
And here's the stat that proves our earlier point about the terrarium. These assets are averaging 96% leased at the time of sale.
Nobody is buying speculative, empty buildings hoping to turn them around. Capital is moving exclusively toward proven, stabilized assets.
Which really brings up the crucial question of capital markets and debt.
Yeah, how are they funding this?
Exactly. If a local wealth manager wants to buy a $2 million suite, or a private investor wants to acquire a fully leased building, how are they funding these deals in a higher rate environment? I assume Wall Street debt funds aren't swooping in to finance a $2 million office suite in Idaho.
You're completely correct.
You absolutely cannot over-leverage your way into a deal anymore. The days of putting 10% down and letting the tenant pay the rest are just over.
The days of cheap leverage are definitely gone. Furthermore, lenders have shifted their primary focus away from the raw asset value and heavily toward the debt service coverage ratio, or DSCR.
Walk us through how a local bank is calculating that DSCR right now.
A bank doesn't just care what the brick and mortar is worth. They care about the underlying health of the business paying the rent.
Right.
To get a loan funded today, the net operating income of the building must easily cover the mortgage payment with a significant margin of safety.
So no thin margins.
No. If the rent only covers the debt by a razor-thin margin, the bank will reject the loan, regardless of the building's appraised value. You really need a fully leased building with an impeccably credit-worthy tenant base.
You know, that stringent underwriting completely explains the buyer pool breakdown we see in the data.
How so?
Well, if you have to put 35% down in cash, and you need ironclad local credit to pass the DSCR test, the buyer pool naturally restricts itself.
It absolutely does. The demographics of the capital deployed over the past 12 months reflect exactly that friction.
Let's hear the breakdown.
Over the past 12 months, 57% of the sales volume came from private buyers, so local wealth or regional syndicates.
Okay.
43% came from users, which are the businesses buying their own real estate.
And institutional?
Institutional capital sits at exactly 0%.
Wow. 0% institutional money. That leaves the playing field completely wide open for private local wealth.
Yeah.
Now, whenever I see office space getting this tight, I usually want to cross-reference it against the local apartment data. Like, if the office market is booming, are people moving into the area and driving up multifamily rents? Does the CoStar benchmark for apartments reflect this same tightness?
Right. I know we usually run that cross-reference to check the broader economic pulse of a region, but the specific Q1 2026 release we're analyzing today is bounded strictly to the office sector.
Yeah, I see.
Yeah. Multifamily, internal occupancy, and rent data are not specified in the report, so we just don't have visibility on the residential side today.
Okay, fair enough. We will keep our focus strictly where the data leads us then. And honestly, the mechanics of this office market have more than enough intrigue anyway.
You really do.
As we pivot to the outlook, let's connect all these variables. We have zero institutional competition, high cap rates, zero new construction, and high demand from local professionals. For the property owner or the investor listening right now, what are the forward watch items based on this data?
There are two critical mechanisms you need to monitor. The first is a very real potential for a severe supply crunch.
Especially for those small spaces.
Exactly. As we discussed, there is no new construction underway. We also have a steady structural return to office demand from small professional services.
Right.
When you combine cap supply with steady demand, specifically in those highly desired sub 5,000 square foot suites, you inevitably run out of inventory.
So what's the metric to watch?
The metric to watch is whether the scarcity triggers a significant sudden spike in rental rates as tenants are forced into bidding wars for a shrinking pool of available suites.
Wow. If you currently own a 3,000 square foot professional suite, you are essentially holding a golden ticket right now. What is the second watch item?
The second item is capital migration.
The outside money.
Right. Right now, as we established, the CDA market has 0% institutional capital, but national buyers have accepted the higher interest rate regime, and they are basically starved for yield.
And the 10.5% cap rate is pretty juicy.
Extremely juicy. That estimated 10.5% cap rate sitting in Idaho might simply become too tempting for out-of-state private capital or mid-tier funds to ignore.
So they might start looking past the illiquidity risk.
Exactly. You need to watch whether outside money begins to overcome its geographic biases and starts hunting for yield in CDA.
And if they do?
If they do, that influx of capital will increase competition for the few available assets. That will likely compress those high cap rates downward, driving property values up.
It's the classic mechanism of capital finding the path of least resistance and highest reward.
Oh,
Which leaves me with a final, slightly provocative thought for you to mull over. Think back just a few years. The massive work-from-home revolution was heralded as the absolute death of the office.
everyone was saying it.
Right. The prevailing narrative was that the American commute was dead forever. But looking at the mechanics of the CDA data, it seems remote work didn't kill the office at all. It hyper-localized it.
Wow. Yeah.
While the massive big city downtown skyscrapers are struggling to survive, the 3,000 square foot professional suite in Idaho has quietly become one of the most stable, bulletproof assets in commercial real estate.
It really forces a complete recalibration of traditional geographic risk models. The perceived safety of the primary urban core has been entirely inverted.
It really has. What does this mean for the future of commercial real estate at large?
Yeah.
Are we witnessing a permanent structural shift where private capital permanently abandons the traditional urban cores in favor of highly functional secondary market ecosystems?
It's a massive question.
It is a fascinating dynamic to consider the next time you evaluate your own portfolio's geographic exposure.
And, for a custom market breakdown, contact Eric Peterson at 509-903-9077.
Thank you so much for joining us on this deep dive. We love untangling these local market mechanics with you. Remember, the data is always revealing the underlying truth of the market if you know exactly how to read it. Until next time.